Hi guys, welcome to my show MKJ Talks for Investment in English. Today in this show, we will discuss about arbitrage fund. So let us start with the definition of arbitrage. It is the simultaneous buying and selling of currency, securities or commodities in different markets or in derivative forms in order to take advantage of differing prices for the same assets. Differing prices for the same asset. So this was the academic definition. Now let me explain in my own simple term. Arbitrage is entering into opposite trade for the same commodity having price difference in two markets so as to earn profit. Now this I will explain you with the help of an example. Then you will understand. Recently you are aware that Reliance Industries announced in its AGM its future plans. It made various mega claims regarding their future prospects. As a result, there was lot of excitement in the market, and it was expected that Reliance Industries share will jump the very next day when the markets will open. And on the next day, there was so much of fluctuation in the market, and you will be surprised to know if you have not tracked it. On the same day, Reliance Industries Limited share, such a heavyweight share, it went up by around 10%. So when there were a lot of trade happening in the market, at some point of time, there was a situation when the same Reliance Industries share was being traded, for example, at 1100 in BSE, at 1100 in BSE exchange, and at 1110 in NSE exchange. So there is a gap of rupees 10. So these people who specialize in arbitrage business, what they did, they purchased simultaneously at the same point of time, say 1 lakh shares of Reliance Industries at BSE exchange at a price of 1000 rupees, and sold the same share, same quantities, 1 lakh shares at NSE exchange at a price of 1010, thereby making a profit of 10 rupees per share, and total profit on 1 lakh share comes to 10 lakhs. So this is what is arbitrage business. Now you have understood arbitrage business. So now let's talk about arbitrage fund. Let's define it. An arbitrage fund is a type of mutual fund that leverages the price differential in the cash and derivative markets to generate returns. The returns are dependent on the volatility of assets. These funds capitalize on the market inefficiency and generate profits for investors. So this was again the academic definition. Let me explain it. You are well aware of futures and cash market. In cash market, what happens? If you purchase shares, you have to give cash and you get back shares, and you get shares in return. And if you sell shares, then you have to give shares and you get cash in return, right? And in futures, you can buy and sell shares without making and receiving delivery, and you may settle it later on. So many a time there exists price difference between the two, there exists price difference in these two markets regarding any share. Let us take the example of same Reliance Industries. On the very next day when the results were announced, there was a lot of fluctuation, volatility in the stock market. As a result, many a times the price in cash market was different from the price in future market, right? Derivative market. Now let us take an example. The price in future market is 1110, and in the cash market, price in future market is 1110, and in the cash market it is 1100. There is a difference of 10 rupees. I'll again repeat. Derivative market or in future the price is 1110, and in cash market it is 1100. So there is a difference of rupees 10. So what these arbitrage fund they do, they will purchase say 5 lakh shares in cash market at rupees 1100. They have lot of funds, so they will purchase 5 lakh. Say let us make the example easy. They will purchase 1 lakh shares in cash market at rupees 1100. Right? They have funds, so they are ready to pay and take the delivery. And at the same time, they will sell 1 lakh shares at 1110 in future, in derivative market. So they have purchased the same thing at 10 rupees less. They have purchased it for 1100 and sold it for 1110. Thereby they have gained 10 rupees. So 1 lakh into 10, 10 lakh goes in their pocket. In cash market, they will make the payment and will take the delivery. And in future market, they will keep their order open. Sooner or later, this gap of cash market and future market will bridge. Either the prices will become equal or the situation may become reverse. Say after some time, try to understand, after some times, the two prices they merge. At a point of time, the arbitrage fund manager observes that the price of Reliance Industries Limited in cash market and in future market is 1150. So he will enter into reverse trades. Now he will buy in future market and sell in cash market. So what will happen? This time he has not made any profit, but his trades have been reversed. Now 1 lakh shares which he had received on buying, he will deliver it in cash market, he will get his cash back. And in future market, he has reversed the transaction. As a result, the 10 rupees profit which he made has now been liquidated or has been earned by him. You can understand in two different ways also. You will come to understand it more easily. Now, in future market, what happened? The manager sold the shares for 1110 and bought the same shares back at 1150. So he lost 40 rupees over there. No? He sold it for less price and purchased it for more price. So 40 rupees loss he incurred in future market, which means he will pay 1 lakh into 40 lakh rupees in future market. 40 lakh payment he will make in future market, which he will lose. Now consider the cash market. In cash market, he had purchased 1 lakh shares by making cash payment for 1100 and sold the same 1 lakh shares by making the delivery and getting back the cash at 1150. On every one share, he earned 50 rupees. So in cash market, he earned 50 lakhs. In future market, he lost 40 lakhs. In cash market, he earned 50 lakhs. So 10 lakhs is his overall profit. And now there was no risk whether the market went up or went down. He will feel no risk. He will in any case earn 10 lakh rupees. I will explain you again. Suppose instead of rising, the Reliance Industries shares fell down to 1000. Suppose you imagine instead of rising, it fell down to 1000. And the price of 1000 was same in cash market as well as in derivative market. What the fund manager will do? He will reverse the trade since the price is same. Now he can reverse the trade. He had earlier purchased in cash market Reliance Industries shares for 1110. He will sell the same 1 lakh shares at 1000 in cash market. And in purchase market, in the future market, he had earlier sold. Now he will purchase. He sold 1 lakh shares at 1110. Now he will purchase 1 lakh shares at 1000. Now, since he has settled the trade at same price, so 10 rupees per share is profit, he will earn 10 lakhs rupees. Now you consider the markets separately and then you will understand he is actually earning 10 lakh rupees. Now look at the cash market. He had purchased the share for 1100 and sold the share for 1000, thereby making a loss of 100. The transaction was for 1 lakh shares. On every share he lost 100 rupees. So in cash market he lost 100 into 1 lakh, 100 lakh rupees. Now consider the future market. In future market he had sold the shares earlier at 1110 and later purchased the same shares at 1000, sold at a higher price, purchased at a lower price. So 110 is his profit. So in future market, he will earn 110 per share on 1 lakh shares. His total gain in future market will be 110 lakhs. 110 lakhs gain in future market and 100 lakh loss in cash market, making the overall gain as 10 lakhs. So in both the cases, he has earned 10 lakhs. Once he found the arbitrage opportunity, he entered into the opposite trade, and when the arbitrage opportunity vanished, he reversed the trade in both the markets. You got my point? So it didn't affect whether the price goes up or the price falls. He will earn the same profit which he was ensured of when he entered into opposite trade initially. So this way, in both cases, he is earning 10 lakhs. This was a very difficult example, and I have tried my best to explain you it in the easiest form. Have you understood it? Now this is what arbitrage fund does. So now I'll jotted out certain points. I'll explain you. Now with this example, you have understood the kind of risk an arbitrage fund takes. Very little risk, almost no risk, because his net position is always zero. Now, when initially his net position is always zero, but initially when he entered into the trade, he purchased in cash market 1 lakh shares and sold in future market 1 lakh shares. So his net position is zero. He has purchased 1 lakh, he has sold 1 lakh shares. So his net position is always zero. So thereafter, whether the price went up or the price went down, in both cases he earned 10 lakhs. So this example makes it very clear that there is almost no risk in arbitrage business, because every time the trader enters into opposite trades, two opposite trades, so the question of risk almost gets eliminated unless there is some mistake on the part of the trader. So that is why these arbitrage funds, they have very little risk and almost no risk. Now, we covered the meaning of arbitrage, we covered the functioning of arbitrage fund, we have covered the risk involved. Now the important thing is return. How much is the return from these arbitrage funds? Arbitrage funds on an average, I have observed, I will show you certain good arbitrage funds on the screen also. They provide us with a return of about 6.5 to 8%. On the lower side, I have seen they provide at least 6.5, and on the higher side, they provide around 8%. So on an average, the return is somewhere, I am not talking of the arithmetic average, I am talking of the median. This return is somewhere around 7.5, 7.4, 7.3, somewhere there. So this is the return from arbitrage fund. I think you have fully understood the concept. I have given you two examples. One of Reliance Industries in BSE and NSE, price of Reliance Industries share in NSE and BSE. And the other example was tough. The same share, Reliance Industries, in derivative market and cash market. That was slightly tough. If you have not understood, please see this video again and again. This is very important if you want to invest in stock market. You should know what are futures. I will make a separate video on that also. Now, look at the screen. I will discuss certain popular arbitrage funds. The first fund is Reliance Arbitrage Fund. Look at its return. Very consistent return. On the lower side, it has earned 7.1, and on the higher side, it has earned 7.5% per annum. I am comparing 1 year, 2 year, 3 year and 5 year returns, because 1 month, 3 months, 6 month returns are not annualized. They are for the same period. And if you annualize them, they will also be roughly the same. So you can see it's a good fund and it has given you healthy return with very little risk. Second is IDFC Arbitrage Fund. The same story repeats here. Look, on the lower side, the fund has earned 6.9%, that is over 3 years, and on the higher side, it has earned 7.6% per annum. 5 years return is 7.2%. Every time, on all periods, you will find it to be in profits, because they encash positive arbitrage situations. Positive arbitrage opportunities. So normally they never incur loss. Very rare. Now look at excess advantage fund. It's not a very old fund, so we don't have 5 years details. But if you look at 1, 2 and 3 years detail, you will find on the lower side it has earned 6.9 and on the higher side 7.2%. Similarly, look at DSP advantage fund. Again, it's not a very old fund. You look at 1 year return, it is 7.5, and if you look at 6%, 6 month return, it is 4%. You make it annual return, just double it, it becomes 8%. Look at 3 months return, it is 2%. Again, you make it annual by multiplying 3 months with 4, you get 12 months. So multiply 2 by 4, you will get annual return, which is again 8%. And for 1 month, it has given 0.6. You again make it annualized, multiply 0.6 with 11. With 12, so it is 7.2%, right? So 7.2%. So you will see the fund has again earned somewhere above 7 and a maximum to the extent of 7.5%. Now look at the HDFC Advantage Fund. It has shown a very slightly poor response in comparison to all other funds. Its return on the lower side had been 6.4% and on the higher side it has been 6.8%. So these are the 5 popular funds which I have shown in descending order as per their CAGR over 5 years. Hope you have enjoyed this video. If yes, please do like my video and share my video with your friends, and also share my video on your Facebook account. One important thing, if you have not subscribed to my Telegram channel, I am repeatedly saying in all my videos, do subscribe it, because you are missing something. Because on a real-time basis, I keep on writing something, I keep on posting some messages. And if there is some good IPO, some good investment opportunity, I will definitely post over there. And if you are not a member of that channel, you will miss that beautiful opportunity. So what is the fun of investing in stock market if you aim to miss such beautiful opportunities? So do subscribe my Telegram channel. Its link is given in the description box. With this, I wish you all the best in your investment. May God bless you with lots and lots of profit on your investments. Bye-bye. Thank you.